may begin.
All right, good morning. We are from the University of Arkansas, Fayetteville, and we'll be presenting on Chicago Bridge and Iron. We just want to thank you for being here. We came up with a buy rating based on the strong industry growth potential, the acquisition of the Shaw Group, and our findings from our financial analysis and valuation. We came up with a target price of $55.85, and that's a 10.24% upside potential.
We'll start with a quick business overview. CB&I is a global engineering and construction firm focused primarily on energy infrastructure. It operates in 4 primary business segments, the largest being CB&I Shaw after the recent acquisition, which we'll touch on here in a second. Because CB&I operates primarily in energy infrastructure, the overall health and growth of the energy sector is crucial to CB&I's success. The International Energy Agency estimates a 30% increase in energy demand, which will continue to drive energy supply. Oil is expected to remain the energy source, though natural gas and renewables will continue to increase, the largest in percentage terms. Emerging economies continue to be more and more important by year. 90% of that projected growth comes from emerging economies such as China and India. And emerging economies are also expected to dominate the energy supply growth. Domestically, there's also many opportunities. Natural gas is emerging as a key alternative energy source in the coming years. Due to the booming shale growth, opportunities are abundant in the U.S. Most importantly to CB&I, there's an estimated $38 trillion need in energy supply infrastructure spending, and CB&I is set to capitalize on that. And finally, the relatively high oil and global natural gas prices will continue to drive backlog and consistent project bookings.
There are several advantages we see with the acquisition of the Shaw Group. First, with this acquisition, their business composition will more than double, and all of these businesses, or the business segments, will be complementary. So we believe this will bring new customers rather than creating competition among the segments. Also, Shaw is a very domestic company, while CB&I is very global. So we believe this combination will make them very competitive globally. They'll have a 50% presence in the U.S. and 50% out of the U.S.
So this shift in business structure and geographic presence will cause certain revenue and cost synergies from the acquisition. CB&I will be able to take advantage of the domestic growth in energy as well as the global growth, particularly in this area. Some of these cost synergies that I mentioned deal with duplicate company costs and operational cost savings, such as duplicate CEO costs, duplicate public filings, and the like. Revenue synergies deal with operational efficiencies and will, for fiscal year 2013, range up to $4 and $5 million. After that, CB&I is projecting that revenue synergies will total around $115.5 million. And for the purposes of this project, we simply broke that down over the 5 years we projected. These revenue synergies will be derived from certain business segments, as I said, operating efficiently. Shaw's fabrication using less subcontracting, which is around 3 to 8% of contract costs. So synergies will total around $167 million towards the end of 2017.
Currently, CB&I is trading at approximately 17 times earnings, which is right on par with industry averages. However, when we get the 2012 results in, we're expecting them to be trading around 11 times earnings based on their current price. And going forward, with the 2013 results and our expected revenues and target price, we expect we'll be trading about 9 times earnings. So that's going to make them bargain priced. And then, obviously, driving our price to earnings is going to be a strong earnings per share, going from the current level of about 2.6 to over $6 by the end of 2013. And obviously, driving that is going to be our strong revenue growth, which is coming from our backlog. As of right now, the results that have been released through the third quarter, CB&I, and fiscal year 2012 for Shaw, there's over $22 billion in new awards already, and that's not even including fourth quarter for CB&I. So that strong backlog, CB&I traditionally has recognized about 60 9% of their backlog at the beginning of the year as revenue through the year, and Shaw Group has traditionally recognized about 33%. So using that, we came up with a weighted average burn rate of their backlog, which we used to predict revenue, and we're already nearing our target backlog entering 2013 of $25 billion, which should fuel our strong revenue growth. And obviously, as far as transferring that revenue into income, our projections are for the gross and net margins to remain roughly 12% and 6% respectively, which is competitive with the industry, and those should remain constant immediately post-acquisition 2013, 2014. They may taper as much as 1% due to interest and debt expense, but going forward, they should get as high as 13% and 7% respectively by 2017. Our return is going to be, our return on assets should remain constant, around 7% through 2017. Return on equity is going to drop to about 17%. That's primarily going to be due to an increase in retained earnings. And then, while our liquidity ratios may look a bit troubling, they're significantly below industry averages. Over 55% of CB&I's liabilities consist of billings in excess of revenues. So it's not true debt that's causing their liabilities, but just these projects to be completed. And then as far as the actual debt goes, they have a free cash flow to debt ratio currently over 700%, so they're in a strong cash position, and they're going forward as post-acquisition, they're going to remain about 40%, and then by 2017, they should have a free cash flow to debt ratio near 100%.
As Jared just touched on, we used in order to project our revenue, we applied a certain revenue recognition rate or burn rate, as the industry refers to our projected backlog, which we came up with by averaging new awards from the previous 5 years and just applying it forward. That gave us our revenue synergy, or our revenues, and thus our EBITDA, which is one of the ways we value the firm. We used enterprise value to EBITDA multiple simply due to the fact that it's unaffected by depreciation, amortization, and other accounting treatments, and the fact that it doesn't influence our capital structure. As you can see, EBITDA is approximately $1.1 billion for fiscal year 2013 following the acquisition, and really won't move a whole lot over the next 5 years, although its movement is attributed to the synergies in which we will. Once we had our forward revenues projected, we then applied a multiple that we derived from the industry analysis. It's difficult to analyze the entire industry simply because Chicago Bridge and Iron operates in so many different business segments. So what we did was we tried to include businesses that reflect CBI's end markets. In the end, we came up with a median multiple of 7.23, which we applied to our fiscal year 2013 EBITDA to come up with our $55.50 theoretical price target. We used this methodology to come up with this price target and use discounted cash flow methodology to supplement this price target.
There's several key trends that we noticed that impacted our discounted cash flow model. First, our EBIT margin will be slightly increasing each year. This is due to the revenue synergies we previously talked about. Second, our reinvestment rate will be falling. This is due to a decrease in capital expenditures, which can be attributed to the completion of the merger and less capital expenditures from that. Finally, this will impact our free cash flow, which will increase each year. As you can see from our slide, our CAPM inputs we used to find our cost of equity. This was used in our terminal value assumptions. And on the next slide, you'll see we inputted this into our model. After we came up with our value of equity in common stock, this was divided by our total number of shares to give us an estimated value per share of $56.53.
In order to come up with our final theoretical price, we used a weighting of 35% and 65%, with a lower weighting on discounted cash flow, simply due to its qualitative nature.
With any strong and growing company, there are always associated risks. Some risks we have identified are political disruptions and economic uncertainty due to CB&I's distribution globally. We have also identified risks in the workforce, such as skilled workers. CB&I's future success depends on their skilled workers that are experts in various areas, such as engineering. We have analyzed our target price of $55.85 with a Monte Carlo simulation. We used a 3% terminal growth rate and a 1% standard deviation. Our optimistic scenario recognized revenue and cost synergies from Shaw, with a maximum price of $56.20 and an adjusted price of $55.88. Our pessimistic scenario did not recognize revenue and cost synergies from the Shaw acquisition, and it resulted in a maximum price of $50.36 and an adjusted price of $50.15. Our optimistic scenario confirms our coverage need.
Thank you. If there are
Thank
any
you.
questions, feel free to ask.
Yeah, so I'll get things going from my end. You gave me your business segments. I think that was actually your second slide. What I'm curious about is you talked about natural gas, you talked about oil. I believe you mentioned nuclear energy. You know by type of energy what their exposure is for projects? Do they do more nuclear? Do they do more natural gas, oil? Can you give me any kind of information related to that?
It's difficult to tell because before the acquisition, the three primary segments they all operated in, say, steel plate structures and project engineering. They operate in oil and gas. So
Right.
it's difficult to judge by segment, by end market.
So they don't give any disclosures in your 10K or 10Q that would help you with
As
that?
far as actual end markets and specifically what their projects are, we don't have any specific percentages or actual numbers. They, Shaw Group, they made them divest themselves of their nuclear group because of liabilities, potential liabilities, I believe. Currently, CB&I, a lot of their largest projects, their biggest customer is the Columbia Oil Group, and last year that was 15% of their revenue, and that was just a regular oil project. But then, as far as like they have another major project coming up in Australia that's going to be LNG.
Right.
So they do have a large presence in both oil and
So
LNG.
you think it's really more natural gas focused? Because the risk there is natural gas prices are so low, it's going to disincent utilities from building nuclear plants. So if they had more of a nuclear focus, that actually would be a big risk to them. So you guys might want to touch on that or try to do some analysis to try to help your audience kind of understand that dynamic.
What do you guys count your buy, hold, sell, non-buy percentages or what?
We were
Buying it's a little over 10%, where would that be a hold?
right. We were looking at under 10% would be a hold. So it's not a very convincing buy, but you know, with the economy and the way it is, and obviously also another note would be that when we finished this report, it was in December, so this isn't with the latest updated price, but so the price has gone up a little bit since we finished this.
You talked about Shaw or burning through the backlogs. Does Shaw burn more slowly? If so, why did they run through the backlog more slowly? Do you have any idea about that? Do they have different type of projects that causes them?
Theirs are more long-term in nature. They have a lot more mega projects that are 6+ years. And actually, I think CB&I is going to, a lot of their projects that they're up for contract negotiations with, a lot of them are these mega projects. So the time to complete these take a lot longer than a typical project.
This shop really created lower market multiples because you merged the two, but I didn't see a lot of background information about Shaw's and their equal size. EBITDA, and that type. Did y'all take a look at that?
Yeah, so Shaw's multiple, as far as enterprise value net business, is 10.1. So typically it's a little bit higher than Chicago Bridge and Iron, but it's also a larger company marginally. As far as the new business structure is concerned, it's going to be 52% Shaw, 48% CBI. So it is trading at a higher multiple. However, we still supply the 7.23 median in our analysis, which is about 200 basis points or so higher than it's at Chicago Bridge and Iron.
Okay, so just one more question if you don't mind. You talked about the multiples coming down, tapering the margins in 2013 and 2014, and going to 16 to 11 PE. How do you see that happen? I mean, that's my concern is if you have, when is that PE going to come down? It's going to happen in the next 12 months. Are they really going to achieve 55, 60, 56 bucks a share? You see what I'm saying? Or is that
If the,
right?
what's your first question, please?
Okay. how do you see the margins coming down? I mean, you talked about tapering the margins down in 2013 and 2014. Is that happen pretty quick, or?
As far as their gross and their net margins are just going to be affected negatively by their interest and their debt repayments. And then as far as you asked about
It's an effect on the price.
effect on PE ratio.
Yeah.
PE ratio, they're going to have revenues increase 160%, and going into 2012, they're going to have revenues increase of around 15 to 20%, I believe. Then net income also, and that's based off of our backlog numbers. And like, as far as looking at our 2012 revenues, which haven't been released yet, going through the third quarter, all our projections are on target to meet our projected revenue for this year. And so based on our revenue for 2012, the current share price, we're expecting a price to earnings ratio of about 11. And then if, based on our target price of $55.85, and then our projected 2013 revenues, which up to this point, our backlog numbers are meeting our expectations. They need to add, for the last quarter of last year, they need to add a couple billion more new awards, and they should be on target for 2013 revenues, and that'll give us our price earnings of 1.9.
That decrease in margins is particularly due to the shift in contract structure.
Yeah, they'll be shifting from a fixed price to a reimbursable structure, which will lower the margins a little bit also.
I have a question, going back to your enterprise value, you used a median. Is there a good reason you use a median? And also in your or when you get the median, you also include the company's mean value. Can you tell me why you included the company's mean value?
Sure.
As well as why did you use a median?
Well, we use, so the companies we chose, like I said, operate in similar markets that Chicago Bridge and Iron, like Chicago Bridge and Iron, ACOM, and Presence, for example. Like I said, our infrastructure development. So it's more highways, bridges, and using, helping local governments. Chicago Bridge and Iron, the core business was bridge building and operating in that kind of segment. As far as engineering, procurement, and construction, that's CBL's main business. So those, Floor, Foster River, KBR, those companies are most mimic Chicago Bridge and Iron. So those were natural for us to include. And then URS and Quanta Services offer more consulting type services, which is similar to bonus technology as far as operating software and services to their clients, in addition to the actual infrastructure. As far as using a median, we just decided to use a median as opposed to a median, simply because it really wasn't a particular median.
Yeah, I think follow-up question. Did you consider using the weighted average multiple, especially with business segments, to apply this one? If not, why?
No, we did not, simply because business segments. We decided that you're right, that the consulting services are a smaller side of the core business structure. However, we simply just decided to use a weighted average, equal weighting, simply because most of the companies that operate in this industry are between 5 and 9 multiple, and there are a few that have a higher multiple. So we didn't feel the need to make assuming use some marginal things.
On slide, EPS slide, those are absolute EPS numbers, right? Not growth numbers, is that correct?
Yes.
Yes, sir.
Let's see, slide. I hope I don't run out of time. So, page 8 in your presentation is your slide, price to earnings. It's actually price to earnings growth. It shows your multiple, and you say your forward multiple for 2012 is 16.7. What's your multiple for 2013? Most people would want to see what it is today, what you think it is next year. Just put it on the slide somewhere so we'll have a feel for valuation that way. Is the multiple compressing, and is that going to drive some potential price appreciation?
All right, well, thank you.
You're welcome. Good job, guys.
Thank you.